Rigetti Computing is understandably getting a lot of attention from investors. The price has been volatile and the industry has achieved a lot of attention in recent weeks following Alphabet's breakthrough in quantum computing. So if that's one of you, if you're interested in Rigetti Computing, there's a couple of things that you should know about this company. At the very least, of course, there's a lot more research you should do beyond just this video before making an investment decision. But I'm going to highlight a few factors that you should know at the very least about this company.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company says that they believe their 9-qubit Novera QPU is ideal for experimentation across a variety of research areas. And they made this available to partners for research and experimentation. And so partners are tinkering with this technology now, and they will likely give the company feedback and let them know what's working, what could be improved, what things that they would like, what things that they're able to achieve with this technology. And this iterative process could deliver huge upside or nothing at all. That's the nature of experimentation. So getting into the company's financials, revenue in the third quarter of 2024 were $2.4 million, and that was down from $3.1 million in the third quarter of 2023. So they have added to their sales and marketing staff and expanded their lobbying efforts. And in these early days of Rigetti Computing Corporation, the majority of their revenue is going to come from government institutions and research institutions, etc. So it makes sense to add some sales and marketing people and some lobbyists that can go and communicate with these institutions and influence them to purchase their services or to give them a grant or maybe a government funded loan, etc. So these are critical categories for the company to focus on in the early days to give the company some cash flow coming in, so that they can fund more research and hit more milestones. And these early revenues will give the company some time and runway to when the industry is more mature and more applications for industry have been developed, and then they can be on more stable footing. So the gross profit margin in the third quarter was down big time to 51% compared to 73% in the same quarter last year. But that's okay. That's not even a concern for investors in Rigetti Computing. These early gross profit margins, up and down, the volatility, the company says it's to be expected at this stage, and that's reasonable given that these various contracts that they sign and the deals that they get, they're so different and they're so bespoke at this point that it's not indicative of the company's operations or a deterioration in the operations. Usually when you see this kind of gross margin decline in a more mature company, alarm bells would be going off. Like, why did the gross margins fall? Did the company experience a huge increase in cost that it wasn't able to offset? Did the buyers of its services execute negotiating power and force them to accept lower margins? Did something happen industry-wide that caused the average selling price to fall? So it would be alarming if this was a more mature industry. But being that it's in the very early stages and these contracts are really one-off and bespoke, it's not really a concern for Rigetti investors. So their recent contract to deliver the 24-qubit quantum system has a lower gross margin profile than most of their other revenue. And so you could see the factors that I just discussed about earlier, right? Just one contract had the impact of lowering and reducing the company's overall gross profit margin by such a large magnitude. Okay, so getting to the expense side. Total operating expenses in the third quarter were $18.6 million compared to $19.1 million in the same time last year. And right off the bat, you notice something here, and that is when you compare $18.6 million in operating expenses compared to just $2.4 million in revenue. And so you can understand the stage of this business in its infancy. still spending significantly trying to develop the technology, spending significantly on research and development, while revenues are still very, very low. So still really early stages for this business. And so the balance sheet becomes more important. How much cash do they have? How long can they sustain with this kind of negative operating income? And so they do have cash and equivalents and available for sale investments at roughly $93 million as of September 30th, 2024. Additionally, during the third quarter, they raised $12 million more with the sale of 11 million common shares. So 93 million in cash equivalents, let's say, and a net negative, as we noticed here, of roughly, let's say 15 million, okay? Let's say they're losing 15 million every quarter. So if they've got 93 million in cash and they're losing 15 million every quarter, that gives them about 6 quarters of runway, or about a year and a half at the current pace, before they need to raise more capital. But the companies, so that would take them to about, let's say a year and a half would be, about mid 2026, which is what the company is saying, that their cash and balances are sufficient to meet their anticipated operating cash needs until midway through the first quarter of 2026. So about a year and a half from now. Now, you've seen the volatility in the share prices of Rigetti in recent weeks. The price has soared, and today the price is actually down by 33%. But in previous days, the price has soared. And so if the price continues to demonstrate this kind of volatility, what management could do is, during those few days when the stock price spikes, they can sell additional shares and raise more capital. So they have 60 million shares of stock available to sell if the price is favorable and they find an opportune time to raise that cash. And that way it'll give them a longer runway before they need to raise capital again. So when you're in an early stage company, those are critical opportunities you've got to take advantage of. You don't know if they'll come up again. And giving yourself that runway is critical. It's critical. It's survival. And in that time, you might find another opportunity to raise more capital. So by giving yourself an extra 3 months, an extra 6 months, an extra 9 months, you open the possibility of your long-term survival, which is in question when you're such an innovative company, losing so much money with an unproven product, with an uncertain industry, right? So you need to give yourself time so that you can develop this technology, let the ecosystem mature, let the industry mature. And that's what they're doing. So they're doing a good job of that. Okay, so these are things that at the very least you should know. There's more you should know about this company, but at the very least you should know these few things that I highlighted in this video. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.